just raise your hand to me if you'd like to ask a question, and please state your name and your affiliation before your question. Please use the microphone in front of you by pushing the button and waiting for the green light. So with that, I will turn to the Senior Deputy Governor for her opening statement.
Good morning, and thanks for coming out on this beautiful summer day. We waited long enough for that. Governor Poloz and I are pleased to be here to answer your questions about today's interest rate announcement as well as our MPR. Let me start by reviewing recent developments in the Canadian economy before turning to key points of Governing Council's deliberations. L'économie canadienne se remet du ralentissement qu'elle a connu à la fin de 2018 et au début de 2019. Enfin, les données économiques récentes nous ont amenés à revoir à la hausse notre projection pour le deuxième trimestre. C'est en grande partie à cause d'une forte hausse de la production de pétrole et d'un rebond après les ralentissements liés aux météos plus tôt cette année. On s'attend maintenant à ce que la croissance de l'économie ralentisse cet été et se situe près de celle de la production potentielle au deuxième et troisième trimestre. En même temps, l'inflation demeure près de 2%. The fact that Canada is picking up while the U.S. economy is slowing sounds like a divergence. In fact, it's a process of convergence. And this is because the two countries are at different points in our economic cycles. The U.S. is slowing to a more sustainable pace, while Canada is moving back up to its trend growth. Activity here at home is being supported by a policy rate that's lower than south of the border. By the second half of this year, growth should be similar in both economies as they converge on their respective levels of potential activity. Meanwhile, at the global level, escalating trade conflicts and geopolitical tensions have been taking even more of a toll on trade and business investment than we had expected. Several major central banks have said that they are ready to provide more accommodative monetary policy or have already taken policy actions. In this context, global interest rates have fallen considerably since April, and the Canadian dollar has appreciated. We've said that we're paying particular attention to Canadian household spending and the oil sector. Consumption has rebounded and should continue to be supported by a solid labor market. So far this year, we've seen strong job growth, unemployment is still near historic lows, and wage growth has picked up. Also, the housing market is evolving as we have expected at the national level. Adjustments to previous speculative activity and changes in housing financing conditions have been difficult in some markets. We've seen signs that the housing market is improving in the Greater Toronto area. Prices and activity are still adjusting to more sustainable levels in the Greater Vancouver area, and Alberta's market continues to adjust to lower oil prices. At the same time, interest rates on 5-year fixed mortgages have fallen recently to around where they were 5 years ago. This is relevant for people buying a new house or renewing their mortgage. It also reinforces our view that residential investment is once again contributing to growth. In the oil and gas sector, we expect that transportation constraints for crude oil will ease gradually. The Trans Mountain Pipeline expansion will provide a welcome boost to capacity, although the pipeline will come online beyond our projection horizon. There are also some positive developments in offshore oil in Newfoundland and Labrador. Despite this, we expect overall investment in this sector to contract further in 2019 before stabilizing over the next 2 years. All told, this would bring oil and gas investment down 20% since 2017, on top of the 50% drop following the 2014 oil price shock. Now, it's worth reminding ourselves that oil and gas production is still contributing some $65 billion to the Canadian economy. In addition, construction related to Trans Mountain and to the LNG terminal in British Columbia will add to business investment. While recent export data for Canada have been encouraging, the trade environment continues to be the biggest wild card for our outlook. Le Conseil de direction a longuement discuté l'évolution de l'environnement du commerce international. Depuis notre RPM d'avril, les droits de douane imposés par les États-Unis sur l'aluminium et l'acier, ainsi que les contre-mesures adoptées par le Canada, ont été levés. On a aussi vu des progrès sur la ratification de l'accord Canada-États-Unis-Mexique. Ce sont des bonnes nouvelles. Par contre, les mesures prises par la Chine à l'encontre de certains produits agricoles canadiens et le fait que la guerre commerciale entre les États-Unis et la Chine se poursuit, ce sont des facteurs clairement négatifs. We've increased our estimate of the impact that trade actions and related uncertainty are having on the economy, both globally and here at home. For Canada, while exports are still expected to grow over the next couple of years, we forecast them to be around 1.5% lower than they would have been without the trade uncertainty. We've also marked down the level of investment by 3% in 2021 for the same reason. Investment outside the oil and gas sector is still expected to expand nonetheless. Businesses across Canada tell us that they plan to invest to increase competitiveness and to meet demand for their products. And here's the bottom line. When we take into account the impact on the global economy and commodity prices, trade conflicts and uncertainty are projected to reduce the level of Canadian GDP by as much as 2% by the end of 2021. Now, we've said for a while that the risks to output and inflation from the trade war are two-sided. As the situation persists, two questions become critical. The first is whether these risks are balanced, and the second is what this means for monetary policy. Staff did some excellent work to inform our discussion, and you can see the results in box 2 of the Monetary Policy Report. They analyzed two scenarios that can be thought of as extremes: an unfavorable scenario in which trade conflicts escalate significantly, and a favorable scenario in which they are resolved. They held fiscal and monetary policy unchanged so that the economic effects would be more visible. The results are clear. The impact on growth, both globally and in Canada, is much larger in the unfavorable scenario than in the favorable one. That underscores how much we all have to lose if the trade war escalates. As for inflation, it actually rises in the unfavorable scenario, even as the economy weakens. And that's because a full-blown trade war would affect supply. Trade patterns and global value change would be severely disrupted, and this would lower productivity and reduce economic potential. It would threaten our living standards. At the same time, slower growth in this scenario reduces commodity prices and leads to a sharp decline in the Canadian dollar. While lower currency would help contain the decline in exports, it would also put strong and persistent upward pressure on the prices, as would the direct effects on tariffs. Now, it's clear that monetary policy could not simultaneously buffer the impact on growth and keep inflation in check. Central banks in advanced economies have not faced this type of trade-off since the 1970s. Évidemment, pendant nos délibérations, on a aussi discuté de la mission première de la Banque du Canada, la maîtrise d'inflation. Nos mesures de l'inflation fondamentale se sont situées en moyenne de près de 2% au cours des derniers trimestres. L'inflation globale devrait baisser temporairement dans les prochains mois en raison de la dynamique des prix de l'essence et d'autres facteurs fugaces. Elle devrait retourner durablement à la cible vers le milieu de 2020, à mesure que les capacités excédentaires se résorbent et que ces effets temporaires diminuent. Let me wrap this up. The Canadian economy is returning to potential growth. However, the outlook is clouded by persistent trade tensions. Taken together, the degree of accommodation being provided by the current policy interest rate remains appropriate. As Governing Council continues to monitor incoming data, we will pay particular attention to developments in the energy sector and the impact of trade conflicts on the prospects for Canadian growth and inflation. Finally, I'd like to say a few words about Deputy Governor Lynn Patterson. Many of you know that she will retire from the Bank of Canada next week. Her contribution over the last 6 years to the bank and to Canada has been exceptional, and in areas as diverse as financial markets, payment systems, and monetary policy. She will be a hard act to follow. So with that, Governor Poloz and I will be happy to take your questions.
Thank you, Ms. Wilkins. So we'll go to questions. The first question is from Reuters over on the left.
Thank you, Governor, for taking my question. Governor, at what point does the strength of the Canadian dollar become a problem for Canadian exporters?
Well, oops, need this. That's posed in a very precise way. I mean, of course, what we do is we always take account of the Canadian dollar as a prime ingredient in our forecast. So mechanically, as the dollar rises, of course, that reduces our competitiveness, cost competitiveness in international markets, and it can slow down our export projection. Our projection, as we have it presented today, is based on a recent average for the dollar, which is around 75 cents. Today we're just around 76 cents. 6 or 8 months ago we were at 73 cents. We had 78 cents. So all those numbers, I've all taken into account. They have very small effects on the margin of our export forecast. So just suffice to say that whatever it does is fully taken into account each time that we do a full update. But I don't have a precise number for you, but when it begins to hurt.
And as a follow-up, to what extent did the more dovish approach of other central banks play into your announcement today?
Well, central banks all make their own policies based on their own situations. I mean, certainly, I'm sure what you have in mind is that over the past few months, we've had a significant decline in bond yields around the world. And that, of course, has, as usual, been transmitted into our bond markets at the same time. And this, in turn, gets transmitted into many of our borrowing rates, such as mortgage rates. Not 100%, but a large share, perhaps 60% or certainly 50% at least, gets transmitted in. And so, of course, that also figures into our analysis. And we did observe directly, for example, that 5-year mortgage rates today, fixed mortgage rates, are about the same as where they were 5 years ago. And that's relevant because such a high percentage of the mortgage market takes a 5-year fixed mortgage rate. And so, as you know, since interest rates began to rise, we've been monitoring closely how those higher interest rates are affecting people as they renew their mortgages. And so it's relevant to note that, in fact, today, people who are renewing 5-year-old mortgages are renewing at basically the same rates that they saw 5 years ago. So there is no effect on their cash flow. Now, there are people with shorter mortgages that are higher than their original mortgages, and those who renewed, say, 6 months or 8 months ago had a higher rate than 5 years ago. So we monitor that on a micro level. And so that does figure in, but in terms of the actual tone, I think that has to do with people coming to grips with the downside risk associated with escalating trade actions. And as we say in our report and in the press release, that evidence is accumulating that the effects of that trade war are becoming tangible. We've observed that sooner in Canada than in other countries because we had tensions around NAFTA long before we had this later phase. And so that affects investment directly, and it's slowing economies primarily through the investment channel. And that, of course, is a shock that we're all monitoring, and we're hopeful that resolution will occur and we get the positive scenario as opposed to the negative scenario.
Thank you.
Next question is Greg.
Greg Quinn, Market News. Good morning. There have been some comments from Governing Council in the past that the next move could be more likely to be an increase than a cut. Is that still the case now?
I think for now, what as we've said today, the conditions that we observe are consistent with today's setting of the interest rate, getting us to a steady inflation performance. We have our eye, of course, on our forecast for inflation 1 to 2 years from now, and that is on target. And so in that situation, suggests that there are sufficient headwinds operating still in the economy that keep interest rates roughly where they are until those headwinds show signs of dissipating. So I don't have to list those. We all know what many of them are. So until such time as those headwinds worsen or dissipate, then we're content with today's setting of interest rates.
Secondly, I believe the statement has dropped the words about being data dependent. What's the meaning of that? Are you no longer data dependent?
That's a serious question. Really? Okay, just want to make sure. Because, it does say, I think, that we're monitoring data, we're monitoring developments. That's just another way of saying we're data dependent. We're always data dependent. And, it's just, there's no point in having a particular key phrase repeated or not repeated. It's just a way of saying that you watch the data carefully. We always do, but there are times, such as we've been through of late, where there are enough questions around where the economy is that it's not as though you can plan ahead. The data are really going to dictate how the balance of risk is tilting. So that's usually what we mean by data dependent. Like, you can't just assume everything's fine because there are too many competing risks in the outlook.
Next question is from Luke, Bloomberg.
Hi, Governor and Senior Deputy. I just had a question kind of following on, Greg, on the difference between data dependence and outlook dependence, because right now, another central banker who's championed a risk management approach, Jay Powell, is widely expected to reduce interest rates despite a very buoyant labor market stateside and the economy still holding up pretty well. He's said that an ounce of prevention is better than a pound of cure in terms of his approach to making sure the expansion stays on track. Do you share that approach, and is that influencing your decisions and deliberations currently?
Well, we share that approach completely. Fact is, though, that our forecast, as we're presenting you today, shows inflation on target and the economy returning to its potential growth track from below. When we said that 3 months ago, the data were not very supportive of that. However, I must commend the forecasters in the background who did such a superb job of getting 0.4 exactly right, and then being willing to say that yes, the data will improve as we move through the spring and into summer. And so as those data come in like that, that increases our confidence that the narrative is right and that therefore inflation will stay on target. So, of course, if something were to happen to reduce our confidence in the real economic outlook, that would reduce our confidence that inflation would stay on target. And so sustaining the expansion, if you heard me put quotes around that phrase, Sustaining the expansion is about keeping growth somewhere around potential, so that if it did fall below potential, then you would be opening up an output gap again and putting downward pressure on inflation in the future. And that of course means that keeping inflation on target in the future means sustaining the expansion in the near term. But as you can see in our forecast, on current setting of interest rates, which by the way are quite a bit below U.S. interest rates, that degree of support is giving us the outlook that we're providing you today.
And then just to follow up on what was noted in the opening statement about the convergence of U.S. and Canadian growth, even for next year, the forecasts imply a material quickening of Canadian growth and slowing of U.S. growth. I know you talked about it from the macro level, but can you wrap your head around why we should be seeing that, given that the bank's narrative has been about a rotation of demand and foreign demand and exports and business investment rather than the Canadian consumer supporting growth?
You can't have an expansion without some support coming from consumers. So we do have consumption growing, and we have residential investment, which is part of what we call household spending, returning to growth as well, contributing less than maybe it had been over previous years. I think what's happening in Canada that's different from the U.S. is just where we've come from. We've already forgotten maybe that last fall we had another drop in oil prices, which meant that an important part of our economy is now going through important adjustments. I said investment in that part of the world is going to be down 20%, which is enough to hit our bottom line. But once it stops falling and stabilizes, and the other part of investment that's occurring in other parts of the economy, in ICT, other data, other digital things, that will take precedence. And of course, businesses across Canada are telling us that. The other thing that has been different for Canada is that the housing market has been adjusting to tighter financing conditions, partly because of B20 and the past increases in interest rates, and also just a reversal of some speculative activity in some major areas. Now that as well is starting to stabilize, which again will mean that it will no longer be a drag on growth. And so, yes, we do see a pickup close to our potential, which isn't as hot as the U.S. economy has been growing. The first half of last year they were greater than 40%. And then in the U.S., they've got a different dynamic because their monetary policy increases brought the policy rate to a tighter setting than in Canada. And past fiscal stimulus, which had been creating kind of a nice boost to growth there, is going to kind of wane by the end of the year. And so they will no longer have that lift. And so that's why they're slowing. So these are the cyclical things that I was trying to talk about. And it's entirely consistent for Canada in this circumstance to grow just a little bit faster than the U.S. as we adjust towards potential from below and they adjust from above. Of course, there are risks to the outlook. Governor talked about those. And I think we both agree that trade tensions, either escalation or just bigger impacts from data, from uncertainty, present a downside risk to growth. I think that's part of the reason why we need to be particularly focused on the data in that regard, because we can try as hard as we can. We have this time marked down our forecasts because of bigger implications from uncertainty. But it's not something you observe directly. You see it in the data when you get it. And that means that we need to adjust our forecast and adjust our expectations as we see the data going forward. And we'll continue to do that.
Kevin.
I want to return to Luke's point about a precautionary cut, which is obviously part of the narrative in the U.S. Would the Bank of Canada consider doing that, given that you've discovered that the trade risks are in fact unbalanced? Would you take out insurance policy even if you didn't see it in the inflation forecast or your number, or the data in front of us maybe suggested it wouldn't necessary? Would you sort of go against such a forecast and cut interest rates just to be sure?
So I want to be sure that you understand I'm not commenting on the American situation or their monetary policy, because that's out of school. But we identify risks all the time, and if we identify risks that unbalance our forecast, then our forecast gets tilted. So the forecast we present to you today is balanced. We say in the front of the risk section that it's technically not possible for us to balance the risks around trade risk just because so many possibilities are out there. And actually, this is the same conversation we had 2 years ago and so on with the NAFTA risk. Because there are like, I could probably identify 10 different scenarios between the one that we're living in today and the bad scenario that we present. And that's why the thing comes across as unbalanced, okay? I mean, I'm just saying to you that let's not forget there's an upside risk here that occurs if there's resolution and the uncertainty fades and investment begins to pick up again. We could still have some tariffs and so on, and we'd be able to do the math around tariffs. But it's the sentiment part which has been the important driver of the global slowdown. So if that uncertainty gets lifted one way or another, we can get a firming of growth. The downside scenario, the one we've laid out there, is almost the worst one we could think of. Just to make it simple, 25% on everything. Bearing in mind that some tariffs out there are already existing, like they're not going from 0 to 25. Sometimes a tariff might be 18 and it becomes 25 in that scenario. So it's not like an across-the-board increase of tariffs. But anyway, that's an aside. So in that setting, that's taking a really extreme one, and that makes it look pretty unbalanced compared to what's the positive thing would occur if everything was resolved. But of course, we could create a scenario that was more realistic, perhaps, if we had announced policies. Well, okay, this is the outcome with China, and this is the outcome with Europe. We say, well, all right, then that we can put in our models, and that would be a downside scenario. It would be much more balanced probably with the upside one that we're identifying now. Still would probably come across as being unbalanced because there'd be incrementalism in the negative scenario. So we don't try to balance those things because to do so would mean taking them and now deciding, well, what's the probability associated with the upside scenario and the downside scenario, the relative probabilities. And, the rest of the probability would be like a muddling through, no change kind of scenario. And I'm not comfortable making up probabilities like that and then convincing you that the new forecast includes all that and therefore is perfectly finely tunedly balanced. So we decided to keep it apart, and all our regular risks are counted in there in a balanced way. But so to get right to the root of your question, yes, if we had faced risks and we believed that they were unbalanced, the forecast would tilt differently. And that would influence our thinking around where inflation is likely to be. And that would be grounds for a discussion around whether it was time to adjust policy. So the theory is there. Okay, the theory is there. But bear in mind one last thing is that when you're in a setting where like where we were last fall or December, the economy was slowing very quickly or rapidly right before our eyes, and at the same time we're contemplating enhanced trade risks. So in that setting, everything kind of feels bad. But when you're in a setting where everything seems to be picking up speed like it's supposed to, and there's a negative risk, that context is shifted. So you're less likely to be thinking, oh, maybe the downside's even worse than we thought. Right? So there can be quite a difference there, and that's exactly why we're trying to help people understand the levels of things matter quite a lot. If you're starting in the U.S. from very rapid growth and slowing to potential, that's actually a desirable outcome because it means that any risk of inflation pressures would be dissipating. But anyway, that's, and for us, it's a rise in growth, which is reducing the downside risk on inflation. So that's the way we see it.
My second question is about the labor market. it's on fire based on the data. Yet the overall growth itself is mediocre, maybe even a little less than mediocre at the moment. Does that suggest what's going on in the labor market is a bit fragile? What do you see happening there?
The labor market is very healthy, and in fact, job growth, kind of average job growth, getting away from monthly fluctuations, has been a little bit above what we would consider to be trend for a little while, for the last year. When you talk to businesses, they also tell you that there are labor shortages in most areas. They're not necessarily notable relative to historical norms, so on fire might be a strong word, and certainly there are pockets in the country where people wouldn't say it was on fire at all. In fact, they'd say the opposite. That being said, economists have been perplexed by the timing of GDP growth and in hiring for many, many years. And so they don't always correspond. What we thought last time when we were looking at the labor market and how strong it still was relative to the weak growth we saw in Q4 and Q1 was that, well, it looks like it's concentrated in particular areas. In fact, what companies have on their minds is that they need to hire, in fact, to be ready for the growth that they tell us they expect to see. And so I think that from a business planning point of view, you can imagine that's part of what's going on and how you would square the circle.
Next question is from Kim.
Hi, thank you. Kim McCrail from the Wall Street Journal. You have talked about in the past the limits of monetary policy in dealing with trade conflicts when you have a situation where you have potentially rising prices at the same time as you have slowing growth. And there was quite a bit of emphasis on that in the NPR today and again in the statement. Did you feel that was something that people needed reminding of at this point?
Not too keen on these buttons. Doesn't work that well. Anyway. Yeah, I think it bears clarifying. I think that was, I mean, we needed it well clarified for our own deliberations. And so we asked the staff to develop the scenarios that we've presented to today. And, you know, that negative scenario, which I think it's an extreme one, of course. So a more moderate version of that, it seems to be on a lot of people's minds. Certainly, if we look at what bond markets have been telling us for the last number of months, that kind of seems to be the preoccupation, that there's a downside risk to the global economy, and it's significant enough to bring long-term interest rates down quite substantially, and to have central banks looking at a shift in how much accommodation is needed. Well, I think understanding the shock is important because we shouldn't, I think, go into this assuming that central banks can somehow fix this if this is what occurs. And I think that's what that very negative scenario shows very clearly. And we've made this point for a while, that in fact, certainly for economies like ours, which are highly trade dependent, also commodity dependent, that when you have a slowdown in global growth that would be for sure would accompany an escalation in the trade war, you get not just the trade effects, you'd get the commodity market effects. And the natural variable to do the adjusting for small economies is the exchange rate, certainly the commodity-dependent economies like ours. And so that's all part of our modeling, and so it comes out very clearly in that simulation. And so we know that prices rise when you impose tariffs. That's simple. We can look around and we say, well, there's not a great deal of evidence that tariffs have had much effect on prices so far, although I have seen studies that in the United States, the calculations are starting to add up, you know, when you include, you know, major appliances and things like this. They've been smaller, like in our own monitoring of inflation, 0.1 or so, and mainly that's because so far the tariffs have been mostly in intermediate goods, and so they're kind of buried into the production process, steel and aluminum, that kind of thing. But once you do what we did there, which was on everything, it's much more there in your face, higher prices. Our belief is we've modeled as if they all go up the same day, but in fact, they would probably kind of go up in a kind of a process. So that starts to feel like inflation to people. Certainly, it's going to feel like inflation to consumers. And then on top of that, what happens is the exchange rate depreciates and adds on what I call a hump in inflation, which is pretty meaningful. In our case, 3 percentage points, if I remembered it right. Yeah, 3 percentage points. By about a year from then, it would be up pretty high, and then of course it would begin to decelerate again because it's a price level story, not a price inflation story. But the key risk for policymakers would be, well, would markets and would individuals all believe us that that's only temporary when it gets to be so big? Could it de-anchor expectations? And so we know from, as Ms. Wilkins referred to, the 1970s, like when there was a major shock, oil price shock, which invalidated a lot of technology and meant a negative supply shock, similar to this in spirit. Central banks kind of misinterpreted that and thought that they could lean into it and keep unemployment from rising. And it turned out they really couldn't. And we had a big bout of inflation that took until the Volcker years to erase. So that's that. All we're saying is that in that moment, you'd have a trade-off between a slowing economy, rising unemployment, and rising inflation at the same time. And obviously, monetary policy would not be able to buffer both of those. It couldn't buffer the downside as well as keeping inflation in check and maintaining inflation expectations. So I don't want to predict how that all might turn out because there's a lot of other dynamics. The demand side could be more important in the short run versus the supply side and all those kinds of things which are very hard to predict. But all to say, it would be a very difficult place for policy, and I think my sense is that the markets are not really on to the complexity of it. It seems a little too easy that, interest rates could decline and that'll make everything okay. That may be true for the small kind of shocks that we've had so far, but I think it would not hold in a more complex scenario where there's an escalation.
Could you be just a little more specific about what you mean when you say markets may not be quite onto that complexity? In terms of
Well, I mean, to put a fine point on it would be that the bond market pushes yields down, and the stock market goes back as if nothing's bad's going to happen. And yet the underlying shock would be clearly very bad for economic growth. It would be bad for the level of productivity. It would be quite harmful to profitability. It would be a pretty significantly negative scenario. To create the downside in yields, it must be a pretty significant scenario to global growth. Therefore, I think it would also be quite significant for stock markets. So I'm just saying the two markets, they may look like they've kind of figured it out, but I think that the complexity is not really revealed in the response that you see in the market so far. And that may be legitimate because, as I said, there's still an upside scenario lurking around, right? And that's where this is all kind of a temporary in a long-term sense. It's persistent, and yet it'll come to a conclusion with resolution. That's a scenario that we should all be bearing in mind, for sure.
All right, we have time for one last question, and I believe Rahul is next.
Thank you, Rahul Vedinath from the Epoch Times. I just wanted to talk a little bit more about the upside scenario to the U.S.-China trade war, if you could. You characterize it as returning to pre-2017 trade arrangements, but I just wonder if, how you see that would be consistent with what the U.S. is trying to achieve with China, or you seem it kind of goes to a status quo, more or less, prior to these trade tariffs as a way to characterize the upside trade scenario?
There could be other ways an upside shows itself. This happened to be one that we felt we could model reasonably because if we go back to what we had before, we know what that is. We know that the world probably wouldn't go back there, but it gives us a sense of just how much we're losing today because of where we are today, and how much we'd have to gain if it came off. So in that regard, it would be a positive for growth, more so for Canada than it would be for the global economy, but for both. The commodity price channel is that reason why, given how commodity dependent we are, why that's the case. And then it would be a mild positive with no policy response for inflation. But it's no surprise that the amount for Canada is the same amount we've got judgment today, about 2% of GDP. Of course, you're quite right that China and the U.S. and others are working towards another spot where we're even in a better place with respect to resolution mechanisms, dealing with international property and other things that would modernize the world trade system. We just don't know what that would look like, and I think it would be a completely different scenario that we would need to model. But if we were in a better place, it would be a positive.
Yeah, I guess that's kind of where I was trying to get to is if there is that scenario where China stops stealing IP and technology transfer and so on, under that presumably hard-won scenario, do you see that would probably be an even bigger benefit to Canada and global trade than what is currently in the extreme upside scenario?
So if you're asking, is the extreme upside scenario we have there the absolute best we could hope for? My answer would be, I hope not.
Okay.
Okay, so if there are no further questions, this concludes the press conference. Thank you, Governor. Thank you, Senior Deputy Governor. And thanks, everyone, for coming.